All right. Welcome to Retire Right, a Wyze Wealth Advisors podcast. Today I'm joined with Nick Lewandowski and Ron Wyatt, all wealth advisors here at the firm. And what we're going to be focusing on today is two specific investment vehicles, mutual funds and ETFs, or exchange traded funds. We're going to talk about how they're similar, how they're different, and why it matters. Ron, Nick, welcome. How you guys doing today?
Doing well, thank you.
Doing very well. Thanks for having us on. Yeah.
Not that we have a ton of episodes, but I know it's your first time joining. How you guys feeling about it?
Good. We'll see afterwards.
We need the riders. I want to talk about my rider after the podcast. I think we can make some improvements there.
Yeah. Well, I appreciate you guys joining. As I had mentioned, we're talking about mutual funds and exchange traded funds, or ETFs. What I'd like to do is just start very high level, and then towards the end of the episode, we'll kind of get more firm specific. But starting high level, can you guys just talk about some similarities and then some key differences between the two?
I'll take the similarities. First of all, you both gain professional management with an exchange traded fund, an ETF and a mutual fund. That could take the form of active management, where you have a manager buying and selling stocks or bonds, trying to outperform or maybe trying to get less risk than the market. Or you could have it could be an index fund format, right? So that's the major thing. Also, you're going to get very easy broad diversification. You buy one vehicle and you get diversification, number of stocks, sectors, and even it can be domestic, or you can even go global with it.
So that's how exchange traded funds and mutual funds are similar. Nick, do you want to talk about some ways that they differ from each other?
Yeah, sure. So there's three key areas of difference. So they differ in the mechanics of how they're traded. ETFs, they trade intraday on an exchange like stocks and are bought and sold that way. With mutual funds, they price once a day in the evening after the market closes, and then the fund company basically processes the buys and sells in and out of the fund. So that's a big area. Cost is another area, and then tax treatment and tax efficiency of each vehicle is a little bit different as well.
And I know that this is going to come up later, so when you say, maybe we'll just define it ahead of time, when you say the price that both ETFs and mutual funds are purchased at, what's that formal term?
Oh, the NAV is the acronym that you'll see and you'll hear us use, but net asset value is what it stands for.
And people can really look at that as like the fair value or price per share, basically.
Yeah, that's correct. So if you think about all the holdings in the fund, if you kind of just look at what their pricing is, that's what the net asset value represents.
Perfect.
Yeah, and just to add one more thing. So the mutual fund, as Nick said, you buy it after the market closes at NAV.
Right.
Where the ETF, as Nick had mentioned, you buy it on the exchange, like a stock. So the price can be a little bit different than the net asset value, which I'm sure we'll cover in a little bit more detail.
Okay, perfect. So then let's start actually breaking down these differences. Again, we mentioned three of them, so we'll just focus on those. Let's go over the cost piece first. So what about, I mean, the simplest way to ask is, why would you say ETFs tend to be lower cost than mutual funds?
So the short answer is they're easier to manage. And so, but there's also another reason, which is more exchange traded funds tend to be index funds. So let me kind of back up. So a mutual fund, let's just say that as an example, we look at mutual funds that buy U.S. stocks. Okay. The average is about 0.5%. That's the internal cost, about 0.5% to own it. Now, if you look at exchange-traded funds that buy U.S. stocks, the expense ratio tends to be a little less than 0.2%. So you can see there's a big gap, right? ETFs being a lot less expensive. Now, partly that's because the ETF structure tends to be a little easier to run. But the second part is that ETFs tend to be more passive passive or, index oriented, right?
The own the market strategy that I mentioned
own
earlier.
the market. That's a cheaper way of doing things. And so part of that lower cost is because they're more likely to be indexed.
Yeah. And when we say passive, I think, a good example is probably the S&P 500.
500, right?
It's just 500 of the largest U.S. companies. Whatever is in that, let's say, ETF.
Own it.
Take VOO, for example, Vanguard's S&P 500 ETF. You're participating in the growth of whatever those 500 companies are doing.
Oh, it is, right?
It is being managed, but nobody's trying to actively do better than the S&P 500.
They're just trying to own those stocks.
Yes.
Right.
And then one other thing that I wanted to mention, you got into expense ratios, and I know at times we call that, internal cost. The formal term's expense ratio. And you used an example of 0.5% for mutual funds owning U.S. stocks and
a little less than 0.2, right?
0.2, a little bit less than 0.2 of 1% to own a U.S. stock ETF.
Right.
Can you explain that? You even said that gap. So that's about a 0.30% gap. If somebody's if their funds cost them that much more, like how does that impact them? What does that mean for them?
The higher the cost, the lower your return. I mean, if you have two funds that buy, say the S&P 500, right? And one charges 0.1% and one charges 1%. Obviously, the one that charges less, you're going to get a better return.
I'd say it's important to know that the expense ratio, the way that works is that money is not going towards your returns. It's going directly to the fund, whether it's an ETF or a mutual fund. So cost does matter.
Yeah. And all things being equal, then we look for lower cost. Now, all things are, sometimes they're not all equal.
Sure. Perfect. And then what about, I know we had mentioned mutual funds and ETFs obviously trade differently. Is there anything in that space that would lead to ETFs being lower in cost than mutual funds?
Yeah, I think when we look at cost from a transactional perspective for like the end client or the end investor, there are some important differences. So typically these days, if you look at the major custodians, Fidelity, Schwab, obviously there are other large custodians as well. Typically today we're trading ETFs commission free, when a buy and sell is placed for the end client, which is a very nice savings that has come about in recent years. On the mutual fund side, transaction costs are a lot more complicated. Mutual funds have been around a lot longer, and the industry has changed over time in terms of, compensation practices, pricing. So, back in the dinosaur age,
when I started,
or before, I was going to say, in the primordial swamp of fund world, essentially things were priced so that the advisor, salesperson, would earn a commission up front on the sale of the mutual fund. It's called a load is the technical term. And then there would be a revenue share fee called a 12B1 fee that was then paid on an ongoing basis to the salesperson or advisor as long as the client held the fund. So pretty expensive, right? When you think about both of those fees. These days, we've migrated away from that to what's called no-load mutual fund shares is much more typical, where there's no upfront load or commission and there's not a trailing revenue share. It's just expense ratio versus expense ratio.
Right.
But what you will still see for a lot of mutual funds is a transaction level fee on the platform, on the custodian. And Ron, I think you said the averages are like between $12 and $25 or something.
Yeah,
like that.
about 15 to 25 is a good range. And what's interesting to make this even a little bit more confusing is, so as Nick mentioned, even if you get a no-load mutual fund, a lot of the custodians like Schwab and Fidelity will charge a nominal fee to trade them.
Right.
Some fund families will have two. They'll have an institutional, and then they'll have another class. The more expensive class, sometimes you can trade without any type of transactional cost. The custodian doesn't charge. But the internal expense ratio tends to be a little bit more. So as you can see, the mutual funds, a lot of differences there. ETFs are much more straightforward.
I used to work at Vanguard, and we would trade mutual funds for clients. And I remember if anybody ever called in and they wanted to purchase a non-Vanguard fund at Vanguard, one, it was actually surprisingly hard, even as an employee, to figure out what all those costs would be. It varied depending on which fund family they were trying to purchase. So if it was a BlackRock fund, a JP Morgan fund, sometimes there were specific time periods they'd have to stay in the fund to avoid a redemption charge. The long story short is that with mutual funds, you need to be able to find that information and look it up. Really, like for each different fund that you're thinking about purchasing, ETFs are just a simpler process.
Yeah, sometimes in one fund family, they may have a fund, let's call it ABC fund, and there might be 5 different ways to buy that fund.
Right.
It's confusing.
Yeah. Perfect. So that is a little bit about why exchange traded funds tend to be lower in cost than mutual funds. One difference that we also talked about was tax efficiency. So either one of you want to elaborate on why exchange traded funds tend to be more tax efficient?
Yeah. So there's when you buy a mutual fund, there's a couple things to consider. So first of all, if they buy a stock, say at 8, and then they sell it at 15 for whatever reason, there's a $7 gain. You're responsible for that gain. And it could be a long-term gain if it's held over a year, which is taxed at a lower rate than a short-term gain is taxed as income. Okay, so gains are better than losses, but when a mutual fund does a trade, you are responsible. Now, to take it a step further, what a lot of people don't realize is, let's just say that you go into a mutual fund today. 10 years ago, that mutual fund bought Netflix at $1, and let's assume it's trading at 101 today when I go into it. A week from now, that mutual fund sells a NVIDIA. Let's go say NVIDIA. Okay, it's run so much. So there's a $100 gain. Even though I've only been in it for a week and I didn't enjoy that whole run up, I'm responsible for that gain.
That sounds fair, right?
yeah, exactly. So it's called inherited. You inherit the cost basis of the mutual fund, right?
Yeah.
Nick, do you want to take the exchange traded fund side of things?
Yeah, so the exchange traded fund, the way that they're able to sidestep some of that difficulty is that rather than buy and sell outright, like the transactions that Ron was describing, they do there's an in-kind exchange mechanism. So there are these market participants. They're called authorized participants. They're typically large institutional investors or trading desks, and they have the ability to basically swap holdings directly with the ETF issuer. And so instead of the fund having to sell a security and buy a new one in cash, they go to the authorized participant and say, hey, what do you have some of this? We're trying to get out of this. And they'll literally like swap either a security position or like more commonly a basket of security positions amongst another. That's not a taxable event because of the way the tax code is written. So typically that allows many ETFs, most ETFs, to avoid those capital gain distributions.
So it's really what's happening underneath the hood that tends to lead to the tax efficiency. And so just to summarize, with mutual funds, the securities that are bought and sold within the fund, sometimes they're sold at gains, sometimes losses. Whatever happens is passed through to the investor.
Right.
With exchange traded funds, there's an exchange mechanism going on underneath the hood that I would say, explained simply, is very similar if you have a $10 bill in your pocket and you want to walk into a gas station and get 10 ones. It's, yes, this is oversimplified, but that's pretty much, what they're doing.
Exactly.
So it's just less taxes there.
Yeah. So think of it this way: the exchange traded funds, it's like having your cake and eating it too. Most of what happens inside the fund, any type of sales, really don't create a taxable event for the most part. If you get a diversified fund from a reputable family, it tends to be over 95%. I mean, probably even close to 100% of the trades do not create any type of tax event for you. And so while you hold it, you have growth potential with really not being taxed along the way. And upon death, you get something called stepped up basis where the gain pretty much disappears. Under current tax laws, we'll see if that continues or not.
So
There was one more thing I wanted to emphasize because I think it sometimes, it sounds like we're doing an ETF commercial here to an extent. And there are advantages for sure. And we favor the vehicle because of those advantages in a lot of accounts. But I just want to stress that what we're talking about primarily applies to or only applies to investments in taxable accounts.
Thank you. Yeah.
Right? If you're in an IRA, these gains distributions and even income distributions, it doesn't matter.
Whatever happens inside of an IRA, it doesn't matter. The only time taxes really come into play is when money's distributed.
Yeah, so we want to be fair in that
regard. And as Nick mentioned, we do use some mutual funds. It's not like we're trying to bash it as a vehicle. Right. It's just that ETFs, I think, have a little bit more advantages.
So you using the term that Ron used, have your cake and eat it too. It sounds like a little bit like that, but anytime that I've seen that in life, sometimes that means too good to be true. So why don't we talk about some of the risks with exchange traded funds? I know you had kind of hinted at this earlier, that there's the NAV or the price per share, but it trades during the day. So can you ever buy or sell it at a different price than its NAV because it's fluctuating during the day? And just maybe walk us through like what that risk actually is.
Yeah, so that
what it means.
That absolutely can happen and does happen. Usually ETFs track their NAVs very, very well. What enables that to happen is that, we talked about net asset value before. So everyone that's out there kind of has a sense of like what that basket of securities is priced at.
Right. You can track it during the day. There's sites that show you what the NAV is compared to the price.
Exactly. Right. It's trivial to track. So, market participants are tracking that. They're obviously tracking the prices of the ETFs. And if there's too much of a discrepancy, like if the ETF price gets so low relative to what the portfolio's, value NAV price is, they will basically just come in and buy the ETF shares and push the price back up until
they're buying it at a discount. Right.
Wall Street looks at it as a money-making opportunity and they jump on it quickly. So 100%. That's going to get it back in line.
Keeps it really in line.
100%.
Exactly.
Where you run into issues are basically these kind of crisis events that occur from time to time where two things kind of happen. One is sometimes people start to question the NAVs, right? Because it's like, well, maybe that asset isn't worth what it was last kind of priced at from an NAV perspective because new information is coming out about the economy or this, that, or the other. And the other aspect is just that in times of market crisis, in general, people are not buying a lot. So you don't have that transactional ability to kind of have the price correct just because there are market participants withdrawing, not as much trading activity, and so on and so forth. And Ron, you've been in the industry for a long time in a lot of different environments. So you can probably give some specific examples of when you've seen this.
Yeah, during the global financial crisis from 2007 to 2009. At that time, both equity and fixed income or bond funds, I saw the ETFs drop their price below NAV. During some of the real bad times, like in the fall of 2008 and in the spring of 2009, some equity ETFs dropped 5% below the NAV. I saw some of the bond funds drop 10% below the NAV. And the more recent crisis with COVID, the equities, I didn't see much of a difference, but I still saw it on the bond side. Now, here's the reason why, kind of like what Nick had mentioned. So bonds, treasury bonds are very, very liquid. And
meaning?
Like easy. So liquidity I define as easy to buy and sell at the price that if you buy something at 100 and you can turn around instantly and sell it at 100, that's liquid, right? But if you buy something at 100 and a day later you sell it at 90, that's not very liquid because you're taking a big hit. And so when you get into like a financial crisis and you have less liquid assets, like certain corporate bonds or municipal bonds that are lower quality, that are they're smaller issues, they're not very popular, they're harder to trade. I've seen them drop 5 and 10% below their NAV. So we steer clear of those types of bond funds for that reason, or bond ETFs for that reason.
Well, why don't we use that as a segue? So, in the beginning of the episode, I said we'd bring it kind of more to the firm level. So let's just talk about our investment approach and what are we doing to combat this, price mismatch what are we doing to combat that risk?
You want to talk about the treasuries?
Yeah. So like Ron was saying, the first step is to really think about liquidity, right? So when we use ETFs in the fixed income portion of an allocation, we focus on treasuries. They're the most liquid securities, and so they will very, very tightly track the NAVs just because of the dynamics of the treasury market. And we have a high level of confidence that, even in periods of market stress, that, variations from NAV, if they occur, will be very, very minor, in nature. But there are sometimes we talked before about like how we don't want to do just a commercial for ETFs and say mutual funds are always bad, ETFs the only way to go ever. And so Ron, I'll turn it over there for you to talk about that aspect of it.
Yeah. So in our bond portfolio, we're mostly, as Nick said, treasuries, but we do have some what we call credit, which means that there's risk of default, right? So we use some private debt. Certain advantages to it is that the yield is very attractive and they tend to be adjustable rate bonds, meaning when rates go up, what they pay you goes up. So they're very attractive in a portfolio. We use it in a mutual fund format so that we never have to worry about the price you're selling being different than the NAV.
Right.
We eliminate that risk. But when we're using private markets, you can tend to buy or invest daily, but only request your money quarterly. So there's a little less liquidity, but at least you don't have the risk of the difference between the price and the NAV. Okay, so we try to use it. We have a framework that we put portfolios together, which I'm not going to dive into it now, but we try to have enough in treasuries for that liquidity. And if the stock market's down, we can sell some treasuries to buy stocks cheap, and enough in the private debt to give you some nice income and a hedge against inflation and higher rates.
Gents, I think that was informative, and for the first time on the podcast, I think it went pretty well.
Yeah, great. So one thing I want to add too. So back in 07 and 09, some of these, not just like junk bond funds, but like the aggregate index is like the granddaddy of bond indices, right? So it has treasuries, mortgage-backed securities, corporate bonds, thousands of different bonds in it. And that's what a lot of bond managers compare themselves to. Some of those dropped 10% in price below NAV. So fortunately, I was in mutual funds. So I sold some of my mutual funds to buy those at a discount. So going forward, if there's ever a time where that happens again, right? So hopefully our treasuries, prices hold up, and maybe aggregate, exchange traded funds that invest in the aggregate index go to a 5 or 10% discount. We can just jump in on it and buy assets at a discount. Right. So I look for that on a regular basis.
Well, as you can see, it's not a one size fits all approach. There's, logic to exchange traded funds, and there's logic to mutual fund holdings as well. So if you look at the show notes for this episode, there's a link to our website. If you're interested in having us take a look at your portfolio to see if there's anything from a diversification standpoint to a lowering cost standpoint to a tax efficiency standpoint that you could do better, we give you the ability to test drive our services. If you book what's called an introductory call, we take 20 minutes, explore whether there's a good fit between what you're trying to achieve and our areas of expertise. And by the end of that 3-step process, we actually give you a financial plan, a tax plan, and educate you on our investment approach and where we could help you out, yours to keep. So by all means, please check out the website. And if you think we could help, please feel free to take that first step. Guys, thanks for joining today.
Welcome. Great being here.
Thanks for having us.
Schedule your complimentary review with Ryan and his team today. Just visit them online at wyzewealthadvisors.com or call 724-271-7019 to get started. That's 724-271-7019 to get started.
This episode's content is for informational purposes only. Opinions expressed herein are solely those of Wyze Wealth Advisors, unless otherwise specifically cited. Material presented is believed to be from reliable sources, and no representations are made by our firm as to other parties' informational accuracy or completeness. All information or ideas provided should be discussed in detail with an advisor, accountant, or legal counsel prior to implementation.